Welcome back to our channel. Today we've got a topic that might just change the way you look at money. Ever wondered how billionaires make their financial decisions? They all have one thing in common. They know how to read financial statements like pros. Don't worry, you don't need to be a Wall Street expert to understand this. We're going to break it down step by step so you can read financial statements just like a billionaire. Knowing this could be your key to making smarter investments and leveling up your financial game. But wait, unlock more financial insights and trends by subscribing. Join our channel now for a wealth of knowledge. Let's start the video. The basics first. So what exactly are financial statements? Simply put, these are reports that give you a snapshot of a company's financial health. There are three primary types you need to know. Income statement shows you how much money a company earned, revenue, and how much it spent, expenses, resulting in either a profit or a loss. Balance sheet. It's a snapshot of a company's assets, liabilities, and equity at a specific point in time. Assets are things the company owns. Liabilities are debts and obligations, and equity is essentially ownership. Cash flow. Statement reveals how changes in the balance sheet and income statements affect cash. It categorizes cash flow into operations, investing, and financing. Now let's look at a real example, Apple Inc. If you were to look at Apple's income statement, you'd see a line for revenue, how much money they make from selling iPhones, MacBooks, etc. Then you'd see various expenses like the cost of making those products, marketing them, and running the company. What's left over is their profit. Simple, right? When you check Apple's balance sheet, you'll see their assets like cash reserves, properties, and even intellectual property. Then come the liabilities, what they owe to suppliers or in loans. The difference between assets and liabilities gives you Apple's equity, what the company is actually worth. Understanding these basic elements is the first step in evaluating a company's financial state, just like billionaires do before making any investment decisions. The billionaire's focus. All right, you've got the basics down. But how do billionaires look at financial statements differently? They zero in on specific areas that give them an edge. Profitability. Billionaires don't just look at if a company is making a profit. They want to know how efficiently the company is generating that profit. They analyze metrics like return on assets, ROA, and return on equity, ROE. Asset utilization. It's not just about what assets a company owns, but how effectively they are being used. Billionaires scrutinize asset turnover ratios to understand this. Liabilities. They also carefully examine the nature of a company's debt. Short-term debts may not be a concern, but long-term debts could affect a company's growth potential. Let's take Warren Buffett as an example. When he looks at a company like Coca-Cola, he isn't just interested in how much profit the company is making. He looks at the return on equity, ROE, to gauge how efficiently Coca-Cola is using its equity to generate profits. Buffett is known for preferring companies with a consistently high ROE because it usually indicates a competitive advantage. Similarly, when evaluating Coca-Cola's liabilities, he isn't just concerned about the total amount of debt. He's looking at the types of debt and how manageable they are in relation to the company's assets and cash flow. By focusing on these specific elements in a financial statement, billionaires like Buffett go beyond the surface to get an in-depth understanding of a company's true financial health. Ratio analysis. Okay, so we've talked about what financial statements are and what billionaires focus on when they read them. Now let's move to something called ratio analysis. This is like the magnifying glass of financial scrutiny. Ratios give you a quick yet profound look at a company's efficiency, profitability, and more. Price to earnings ratio, PE. This ratio is used to determine if a company is over or undervalued. A high PE ratio could mean that the company is overvalued, or it could indicate that the market expects high growth. Debt to equity ratio. This helps you understand how much of the company's operations are financed through debt versus equity. A lower ratio is generally seen as less risky. Take Tesla, for instance. Investors and analysts frequently discuss its PE ratio, which tends to be high. A high PE ratio might scare off some retail investors, but someone like Elon Musk might argue that it reflects the market's expectation of future growth in electric vehicles and renewable energy. Additionally, let's look at Amazon's debt-to-equity ratio. In general, Amazon has maintained a relatively low debt-to-equity ratio compared to its industry average. This gives billionaires the confidence that Amazon isn't recklessly accumulating debt. but rather is using its equity efficiently to grow its operations. In a nutshell, ratio analysis is a tool billionaires use to get a more nuanced picture of a company's financial health, often revealing insights that are not immediately obvious from the raw financial statements alone. Forward-looking indicators. So far, we've been focusing on how to understand a company's present financial situation. However, billionaires don't just invest based on what's happening now. They're keen on knowing where a company is headed. Forward-looking indicators help them do just that. Revenue growth rate. A consistently rising revenue stream could signal that a company is well-positioned for future success. Market trends. Observing larger industry trends can offer insights into how a particular company might fare in the years to come. Product pipeline. Billionaires look at a company's future product releases to gauge potential future revenue streams. Take Netflix as an example. While its current financials are important, smart investors also consider the company's subscriber growth rate. If the rate is consistently high, it's an indicator that Netflix is likely to keep performing well. For another real-world example, consider the tech giant Google, now Alphabet. Forward-thinking investors didn't just look at Google's dominant position in search. They also took into account its investments in future-oriented fields like artificial intelligence, autonomous vehicles, and healthcare technology. These ventures might not be big revenue generators now, but they have enormous future potential. By focusing on these forward-looking indicators, billionaires can often predict a company's future performance more accurately, making investments that pay off in the long term. This approach allows them to be steps ahead of regular investors, ensuring that their portfolios are geared for future success. And there you have it. Now you know the basics of reading financial statements and the specific metrics billionaires pay attention to. More importantly, you've learned how to look beyond the present and consider where a company is headed in the future. Just like a billionaire, you're now equipped to make more informed and profitable financial decisions. If you found this video helpful, please hit that like button and share it with your friends who could also benefit from this knowledge. Don't forget to subscribe so you won't miss out on more content like this that can level up your financial game. Thanks for watching.